In this video, you'll find out what accrued expenses mean, and I'll show you how they work with an example. Hey there, welcome back to Accounting Stuff. I'm James, and in this video, we're going to cover accrued expenses in accounting. This is part of a playlist that I put together covering adjusting entries in accounting, which you can find linked up here and down below in the description. So far, we've covered the big picture of adjusting entries, prepaid expenses, and deferred revenue. And very soon I'll be releasing the final installment where we'll cover accrued revenue. So hit subscribe and click on the bell so you don't miss out on that one, and plenty more accounting content that's coming soon. But in this video, we're going to take on accrued expenses with an example. So let's dive in. In true accounting stuff style fashion, we'll begin with a definition. An accrued expense is a past expense that hasn't been recorded or paid for yet. Let's pause for a moment and think about what this means. An accrued expense is a past expense that hasn't been recorded or paid for yet. So this expense will be recorded or paid out in the future, but right now in the present, we're still waiting for that to happen. Got it? This will all become clearer with the example that we'll get into shortly. But first, let's think about how a typical business transaction works. Imagine that we're the buyer and we want to buy something from someone, the seller. They send us the goods or provide us with a service, and in addition to that, they hand us an invoice. In return, we pay them in cash. Voila, transaction complete. With accrued expenses, the seller provides us with the goods or services sometime in the past, but we don't receive the invoice from them or make the payment to them until later in the future. Why does all of this matter? Because as financial accountants, we like to use the accrual basis of accounting. And in accrual accounting, expenses are recorded as they are incurred, not when cash changes hands. I like to think of payments as accounting triggers. When we pay money out of our bank account to a supplier, we code the payment to the relevant account in the general ledger. Receiving an invoice is also an accounting trigger. When using accounting software like QuickBooks Online, you are required to enter the details from the invoice into your accounts payable ledger once you've received it. I'll explain how this works later in the example. Okay, why does all of this matter? My point is that we have two accounting triggers, the invoice and the payment. If both of these are going to happen later in the future, then right now in the present, we've got a problem. We have no accounting triggers to record the goods or services when we receive them in the past. That's when the substance of the transaction took place. That's when the expense was incurred, and accrual accounting is telling us that we need to record the transaction here. But how do we go about accruing an expense in the past? I'll show you right now. Let's imagine that we own a business and there are some basic overhead costs associated with running our office. Things like electricity, heating, and water. We call these utility expenses. And for now, let's focus on water. In our office, we are billed for our water usage on a quarterly basis, 4 times a year. And on each occasion, the bill covers our water consumption for the previous 3 months. Today is November 1st, the first day of a new billing cycle. That means that 3 months from now, on the 31st of January, we'll receive a water bill covering 3 months, November, December, and January, 3 accounting periods. And to keep things simple, let's assume that water normally costs us about $50 per month. Let's jump forward now to November 30th. 1 month has passed and it's the end of an accounting period. Do we have any adjusting entries to post? Yes, we do. We've been using water for a whole month, but we haven't received a bill or paid for any of that consumption yet. So we need to accrue an expense into our general ledger. And how do we do that? We post a journal entry. We need to recognize a utilities expense in our income statement. Water normally costs us $50 per month. So we need to increase our utility expenses by $50. Expenses are the first E in dealer. Normal debit accounts. So debits increase them and credits decrease them. Our utility expenses need to go up, so we debit our utilities expense account by $50. But where does the other side of this transaction go? We are double entry accounting, so there is another side to this adjusting journal entry. We've already hit expenses in our income statement, so we need to temporarily hold the other side of this journal entry somewhere in our balance sheet in our accrued expenses account. But are accrued expenses an asset or a liability? Let's work it out. Assets bring us future economic benefit, whereas liabilities involve a future economic sacrifice. We've already received economic benefit from this transaction because we've been using water for the past month, but we haven't paid for it yet. At the present moment, we are committed to making a future economic sacrifice, so we have to recognize an accrued expense as a liability in the balance sheet. Accrued expenses are always recorded as liabilities in the balance sheet. And liabilities are the L in dealer, normal credit accounts. So credits increase accrued expenses and debits decrease them. So we need to credit our accrued expenses to increase them by $50 in the balance sheet. Great. Let's see how this adjusting journal entry affects our general ledger using T accounts. We have two T accounts, the utilities expense account in the income statement and accrued expenses in the balance sheet. Remember, when using T accounts, debits always go on the left and credits always go on the right. We debit the left-hand side of the utilities expense account by $50 and we credit the right-hand side of accrued expenses in the balance sheet by $50. So we have accrued a utilities expense of $50 in our income statement for November. Now, let's jump forward to the end of December. Another month has flown by. Do we have any more adjusting entries to post? Yes, we do. We've consumed another month's worth of water and we still haven't received a bill or paid for any of it yet. We need to accrue some more utility expenses. The journal entry looks like this. It's exactly the same as the one we posted last month. Why? Because we estimated that water costs us roughly $50 per month. So we need to recognize another $50 of utility expenses in December. And on the flip side, we need to increase our accrued expenses in the balance sheet by another $50. And how does this impact our books? Like this. Our utility expenses now come to $100, 50 of which was expensed in November and another 50 in December. In our balance sheet, we are now carrying accrued expenses of $100. This liability keeps getting bigger because we've now gone 2 months without an accounting trigger to settle this once and for all. We haven't received a bill or a payment in November or December, so we are making our best estimate of what the bill might be at this stage. Okay, now we'll jump forward to the end of January, the final month of our quarterly billing cycle. The water company has sent us an invoice covering the past 3 months, and it comes to $153. So it's not bang on the $150 that we expected, but that's okay. We used our best estimate and we actually came in pretty close. Like I mentioned before, I like to think of invoices as accounting triggers. Here's what I meant by that. When we enter this invoice into QuickBooks Online or whatever accounting software you're using, we need to categorize the transaction. And when we do this, it automatically triggers a journal entry that gets posted behind the scenes in our general ledger. If you run a business and receive lots of invoices, then this automatic posting can become a huge time saver, and it's one of the many benefits of using accounting software. I'll pop a link down in the description to a free trial of QuickBooks Online so you can test it for yourself. It's an affiliate link, so by signing up, you'll have the opportunity to support me making more accounting tutorials just like this one. The automatic journal entry looks like this. It debits our utilities expense account by $153 to increase our expenses. The other side of this journal entry is going to credit our accounts payable account by $153 in the balance sheet. I just want to point out at this moment that we haven't actually paid our water bill yet. We have only received the bill and now we have 30 days in order to make the payment. We owe money to the water supplier, so we have a liability in our balance sheet. How does this affect our general ledger? We need to credit our new T account, accounts payable in the balance sheet, by $153. That's the final balance of what we owe to the supplier. And we debit the utilities expense account in the income statement by $153. But hang on, our utility expenses are now $253. That's quite high. Our final bill was only $153. How does any of this make sense? We accrued $50 of utility expenses in November and another $50 in December. When we add the $153 that was automatically journaled in January, we get $253. Both our expenses in the income statement and our liabilities in the balance sheet are overstated by $100. That's because we have one more adjusting journal entry to post. We need to release our accrued expenses from the balance sheet. So let's do that. The journal entry looks like this. We need to reduce our accrued expenses in the balance sheet. Accrued expenses are liabilities, so we reduce them by debiting the account by $100. Our utilities expense account and income statement is also overstated. This is a normal debit account, so to decrease it, we credit the utilities expense account by $100. We post this journal entry into the January accounting period, debiting the left-hand side of accrued expenses in the balance sheet by $100 and crediting the right-hand side of the utilities expense account in the income statement by $100. When we close off the quarter, we have incurred utility expenses of $153 in our income statement, $50 which we accrued in November, another $50 in December, and then in January, we took up a further $53. There are no more accrued expenses in our balance sheet because we released our $100 accrual in January, and we now owe $153 to our water supplier, which we recognize as a liability in accounts payable. We've recorded all of our expenses in the correct periods as we incurred them, so our books are in line with the accrual basis of accounting. In the next video, we'll round off this adjusting entries mini-series with a video on accrued revenue. Click on this circle to subscribe so you don't miss out on that, and the whole playlist can be found over here. As always, if you've got any questions, let me know down below in the comments or message me directly on Instagram @accountingstuff. See ya.